they do a lot of like investment banking, they give financial advice, and they do wealth management. And they're run through different subsidiaries. So they just acquire businesses and turn them into their different segments. They do.
I asked you guys to turn off the lights in the front so you can see the slide a bit better.
Yeah, yeah. So this is a list of their subsidiaries. B. Riley FBR is probably one of their biggest ones. They do, they're making a lot of changes with that one, and that one has the most growth. Glass Ratner was acquired actually it was finalized this year, and then Wunderlich was, it's not, so they changed the name of Wunderlich to B. Riley Wealth Management, but they acquired that last year. And so those are the two we're going to talk about the most because they have a lot to do with their recent changes in numbers.
And then also, B. Riley is in the process of getting Magic Jack acquired into their company as well. So all of their growth is through acquisitions. It's not organic, but it's doing pretty okay.
Yeah.
So some of the highlights is that we already touched on a little bit. They have a lot of new people within their management, specifically in FBR. They just acquired that in 2017, and they're getting a new chief administrative officer and a new chief executive officer. So they acquired them in, and they're keeping a lot of the same people that already worked in FBR, but they're making huge restructuring changes. They're also having higher than average profits. Their performance is doing better than the S&P 500 on a whole for the financial sector, which is nice to see. And the third highlight is just like a recap of the acquisition of the multiple companies that they're going through.
So here's a chart. It says on the sheet that their beta is at 0.56, but I looked at it again today and it's actually at 0.85. So they're pretty volatile. They're a cyclical market like all of the financial companies, so it really depends on how just everything is doing.
What's the recent sell-off it looks like in October 2018?
So that's looking at this graph, it doesn't look great, and that's why we are actually pitching a hold. The company looked really good about a week ago, and we put a lot of effort into it, and its stock has just been dropping since. On our paper it says it's at 1901. Today it was actually at 18.67, which was an increase from yesterday, but it's definitely going down.
Is there anything that's driving that sell-off?
It could be, well, they have a lot of debt from their acquisitions, so it could be just looking at that, because last year or the year before they had like zero long-term debt, and now they have like $400 million in long-term debt, so it could be looking at that.
Why it's actually increasing, I'm not entirely sure, but I do know it might be, they're going through the final stages of acquiring Magic Jack. I forgot the exact word for it, pending regulatory approval. So I don't know if there's some faith lost in the stock because of this acquisition, because Magic Jack is a local tech company. It's gonna go into their investment segment. But I think a lot of it was talking about their future contributions that they would get from the acquisition that might not be holding true right now.
Okay, it might be something worth looking to see if there were announcements around that same time period, because you see that there is some movement in the market as well, but there's a significantly more dramatic movement in this stock. So you might want to see if there is public information released at that point.
Could it be just because of the market correction?
I mean, look at the movement though.
In October,
It doesn't appear to be just following trend in the market, okay?
We can look more into that.
It's, no, they're on a smaller scale, it kind of looks like
So these are some of our metrics and evaluation. As you can see, the revenue has increased like substantially each year, as well as their net assets, and those are because of the acquisitions that we had talked about earlier. That has pretty much, like, that's what we're gonna be talking about a lot, just because it affects everything. And again, their debt to equity jumped a lot from 6.67 to 390.87. So that's again due to the acquisitions. And then in our valuations, the share price is lower than its price today. Those are our target prices, about 15.76 for the FCFE and 18.28 from the FCFF. And we chose to use these because they just are more relative to our industry. Especially, we put more of the weight onto the FCFF and the relative value from price to book, just because those numbers are more relevant.
We thought it'd be a pretty safe weight to try to weight them all equally since first stock evaluation. But we did put less on the FCFE because while it's the most common metric, it doesn't do as well with seeing the large influx of debt like the FCFF does. And then we chose the relative valuation for price per book because in the financial industry, PV is usually a better gauge of how the company is doing than the PE ratio. And that's because with price to book, you're not dealing with the depreciation of assets because they're dealing a lot with money that don't really go away. So within their management, the management's been around forever. Brian R. Riley is the same name as the company. He is now co-CEO with Thomas Keller. Keller has also been around since the beginning of the company, around 1997. It was in 2014 when they both became co-CEOs. They also have a new president. Keller used to take that president position, but Kenny Young is now there. So within the management, a lot of them get stocks. This last time they got about 221,000 shares split between the the board when they had the acquisition of FBR and Co. Other inside trading though, they have had 4 times that they've sold off the stock this past year with only 2 purchases compared to the 7 purchases in early 2017. And that doesn't really sound like there's a lot of confidence within the management of their stock. But when you look at the number of it, the last sell before the price drop was by the president, Kenny Young, but he only sold almost 2,000 shares when in early 2017, co-CEO Brian Riley purchased, he purchased 220,000 while they were awarded 11,000 each. So, sorry, I got those numbers mixed up. But as far as, I think, management confidence in their own stock, they're still awarding themselves and buying themselves large amounts, so assuming they believe in it.
So their operations and strategies, they acquire, again, a lot of businesses, and in their subsidiaries, I've noticed that they keep a lot of the same managers and a lot of the same employees that were in those businesses before. In Glass-Ratner, they kept the same manager, Ian Ratner. And then in Wunderlich, they kept a lot of the same managers as well. In B. Riley FBR, they have the same employees that they had before, but they just promoted them. So Andy Moore is now the CEO, and Don Farrell is the CAO. So they don't do they don't hire outside of those companies usually. They usually stick to the same people. Alright, and for our comps, as you can see, the numbers are pretty different from B. Riley, but we chose Stifel Financial Corp because we had previously researched them so they were one that we understood. We chose Morgan Stanley because a lot of people know or have heard of them, so we wanted to have something that people could see and like know what they do and like kind of compare it to ours. These are all a little bit more established than B. Riley, I would say, looking at their market cap. I would say B. Riley is a smaller company than than these other three. They have like similar-ish PE ratios, and yeah, the numbers are pretty different here, but we wanted to pick comps that we understood.
And one of the main things is that they have, like, because of those acquisitions, they do have really weird numbers whenever debt is involved.
Yeah.
So looking at their debt to equity, or debt to enterprise value and debt to equity, it looks weirdly above for even the smaller
Yeah.
companies, even though it's comparable to Morgan Stanley, but this is something that will go down for them in the next years as these are paid off. It's just this acquisition that just happened.
Yeah, and while they acquired like huge numbers of debt because of buying their new subsidiaries, their revenue has been steadily increasing, so that's definitely something to take note of.
This is kind of just reiterating on the profit loss highlights. The revenue has increased 57%, while the operating margin it has decreased by 42. It has not decreased more than the percent of increase in the revenue. It's a funny way to explain it, but they're still getting more revenue than what their margins say that they're losing because of the amount of debt that they have. So it sounds like a lot of redundancy in the numbers, but it's all with the same explanation.
And again, current assets have gone up and current liabilities have also gone up. Yeah, we were, the year-over-year averages freaked us out a little bit, but they all make sense because of their activity in the last 2 years. But yeah, again, all goes back to the acquisitions that they made. So, some of their risks were that they did take a huge jump and buy those assets, but I think if it all goes right for them, they have a lot of opportunity to grow. Also, with the increasing interest rates, that's another risk for them, since they're so cyclical and they depend on basically the overall performance of our economy, and just they depend on like how everything goes.
B. Riley did mention increasing interest rates as a specific risk in their 10K, but they explained that the management had already accounted for that type of risk by borrowing with senior notes payable and credit facilities. The senior notes payable have a fixed interest rate, so even if interest rates rise, that won't affect them, and that's what they use the most for borrowing. And then credit facilities have a floating rate that they invest in, and which obviously if they increase, it would increase. But they have balanced it out to help them in case interest rates rise. They feel like this is a risk that they have managed enough that it's not a real risk to them, it's just part of the industry that they work in.
So what's the logic behind acquiring Magic Jack, which seems a little bit out of their wheelhouse?
So I actually read today that this morning, I guess it's not really an acquisition. I read more into it, and they're actually trying to buy all of their outstanding stock. So they're not acquiring Magic Jack, but they're purchasing all of Magic Jack's outstanding stock. So maybe that will be approved or written off. It should be by November 9th. But that might be a strategy to help them deal with their new debt, or
Well, still trying to, so Magic Jack, from what I understand, is like almost like a Skype-like company, right? It's like
Yeah.
So
VoIP.
Yeah.
and this is like essentially a boutique investment bank. So why are they acquiring the company? Are they planning on integrating the technology for their own benefit or
We
customers'
can look
benefit, or who's
more
benefiting
into
from the
that.
acquisition?
Maybe it could help them with their other services because they do work with a lot of like higher up companies, so maybe that could help. They could integrate that like with communicating with the companies, or maybe they just want to build a relationship with Magic Jack to try and integrate that more into their advising. We can look more into that though for
Yeah, because it looks like they've been growing primarily through acquisition, but most of their
Yeah.
acquisitions seem to be within the financial sector, so this seems like a little bit of a non sequitur. So I'd want to understand why they're acquiring this company
yeah.
and what they plan
Yeah.
on doing with it.
Could it be possible it's just because they want to increase their cash flow? VoIP is basically phone through internet.
Yeah.
So there is absolutely no expenses related to that. It's just a product. And that company is, I know it, but that company actually has a small module that you plug in between your phone line and your real phone. And basically instead of going through a utility line, it goes through internet. And
So, but you have a company here that essentially advises, it looks like their primary line of business is advising businesses and high net worth individuals on, and now they have a voice over internet.
yeah, I don't know
So-
either.
So the
but-
business, the underlying business logic, I still kind of want to see if it's something what they're doing with that, right? Because it does seem like it's a little bit like unrelated to their other business practices. When you pick comps, so I probably would want to see a couple different comps here. I don't think like a Morgan Stanley, for example, would be a very good comparable. Given that Morgan Stanley is much more diversified and obviously many, many times larger than a B. Riley.
Yeah.
But I'd also want to see you include maybe price to book, since that is what you're using as the basis of your valuation.
Okay.
If you don't like a free cash flow to equity valuation and you don't think it's appropriate because this company did take on quite a lot of debt and so their debt levels are changing,
Yeah.
then you don't have to include it,
Okay.
right? You could just use the free cash flow to the firm.
Yeah.
And I might recommend doing that. I'd want to see, once again, like the assumptions that went in there, like the growth rate, the cost of equity.
Okay.
Yeah, so I think I'd probably look for some different comps that are maybe a little bit closer to the size and actual function of B. Riley. I'd look into this acquisition of Magic Jack. I'd also probably try to look at what happened between August and October that seems to have kind of caused this precipitous fall in their stock price, because the graph you pulled marks earnings dates, so it's not earnings, right? It isn't an earnings announcement, and it seems like it's more movement than the overall market, so I kind of wonder what's driving that. Yeah, so those would be kind of my key follow-ups for you.
Okay.
Questions from the class? Maybe one other thing that might be helpful, because you guys are covering a sector that's oftentimes not well understood. So one thing that would be helpful in presenting this to the class is talking about, you talked about their different business lines. Talk about what they actually do. What do those things actually mean? Because I think that will make it a little bit more relatable for the class. And I'd like to see maybe a breakdown of like where their revenue is coming from, since they have a bunch of different subsidiaries that do different things. Like, are most of the revenue coming from advising, like what we call high net worth individuals, basically rich people, or is it advising businesses? Because those are kind of different businesses that have like different kind of characteristics. So that would help also kind of understand where they're kind of positioned in the market. Okay.
I have a question for Kim.
Okay.
It looks like like if it was like a holding company instead of a investment banking company, so would the net interest margin be a good thing to look at? Because they don't say holding, but to me it seems like it's a holding company.
Yeah, I did read out it being a holding company. We should-
It does look like it functions like a holding, so what is a holding company? You'll see if, when you guys look at 10Ks, a lot of your companies may be organized in a structure and it's kind of a legal thing to be called a holding company. So I wouldn't get too worked up about like that actual like terminology. But I think your point is more that they operate almost more like
Acquisitions.
kind of like an umbrella for like a bunch of different subsidiaries that are like, or that they don't seem to run very, like, or they don't actively run at the corporate level. In that sense, yeah, I might look at, I might almost compare them more to like a Berkshire Hathaway that is like a proper
Yeah, because
holding company.
I was also looking at this company quickly, and basically they issue mutual funds. They issue mutuals, and so you can have like 6 different funds from them, depending on the holdings they have. It's like a Berkshire, like you said.
Yeah, so I think we probably need to do a little more digging into like what the actual kind of like nature of their business is, and that would help you also pick better comparables. And that if you think of them more along the lines of like a holding company, then like the Magic Jack acquisition might make a little bit more sense, but I wanna see that they had some track record in the past of acquiring other companies that aren't just purely financial. Okay,
Okay.
cool.
Thank you, guys.